All right. Welcome to the Big Skinny with me, Lou Basenese, on a day of the week that is following the busiest day ever in the markets, in my opinion, with the most important news. Is AI real or not? Is the bubble here or about to burst? Folks, sorry, bears, you need to go home because we got 4 earnings reports from the Mag 7 yesterday, another one today from Apple. We had a Fed meeting and decision, and all is good. All is well with inflation, the economy, and AI. And we're going to talk about all that and more. You know me to be the guy at the glass half full. So I'm bringing on some people that bring a little bit more pragmatism and skepticism, including Bob Elliott, the CIO of Unlimited Funds, a former Bridgewater Capital guy. So at least 97 IQ points smarter than myself. And that's part of the gig here, right? We learn to be humble in the markets, or we're going to be humbled by the markets. And the way we live that out is we invite smarter people on to give us their insights, to refine our takes, and find the right investment opportunities in any market. But we're not going to just stop with Bob. We're bringing on Mike Zaccardi, who, if you don't follow his tweets, you're missing out, my friends. This is the chart and market analyst machine on X. Puts out some of the most compelling charts that are out there, really curates them from the top minds on Wall Street and throughout the Twitterverse, and just delivers it right to your feed. So excited to talk with Mike about things like oil, inflation, what the markets are really saying, as well as Bob in terms of the economy, what the IPO liquidity is going to bring. We have so much to cover and more. We're going to do it in our traditional big skinny style. One headline that you should probably ignore, one chart that you should definitely pay attention to because the data doesn't ever lie, and then one investment insight or idea that you should follow to increase your bottom line. Because look, we can have fun here. We can make fun of ourselves, me in particular, like Dodd likes to do. But if we're not making money together, what are we doing, folks? This is a for-profit adventure at the Big Skinny. So let's have fun among friends, because it makes it more fun if we make money. So before we do that, we do everything top of the show with this week's rundown. We want to make sure you follow us on all our socials. X, we call it Twitter until Elon Musk follows us, and YouTube. But make sure you join the conversation. We are live streaming, usually about once every other show. Someone gets in the chataverse and says, "Are we really live?" And then we pop it up on the screen and say, "Yes, Mr. Dodo Bird, we are live and kicking it." So please don't be afraid to join the conversation. You can see we're a little bit cheeky today. We're always that way. We're thick-skinned Italians from northern New Jersey. So throw the zingers our way. We'll throw them back. But ask any question you want, opine, and we'll give you our opinion as well. Again, always focused on keeping the insights coming that increase your bottom line. So let's get right now to this week's rundown. Well, if you've been reading the headlines at the beginning of this week and early last month, the fearmongers were out in full force telling you that this AI bubble was about to burst. And this includes really smart, astute people like, well, Benchmark's Bill Gurley, the guy that was behind The Big Short that crushed it. Folks, end of times. It's like reading the book of Revelation in the Bible based upon these headlines. The world's coming to a catastrophic end, and it's all because of the AI bubble, and a major reset is coming. And lo and behold, yesterday, the hyperscalers reported and said, stuff it. It ain't happening, folks. And we're not talking about just maybe kind of this trend continuing. We're talking about it accelerating, going faster. Just look at the segments, the cloud service segments at Amazon, Alphabet, as well as Microsoft. Now, for those of you that have an uncanny memory for things that don't matter, like movies, actors, and actresses, I have the same ability with quarterly growth rates for some of these cloud service compute companies. And if we go back, for a long time, Amazon was growing north of 30%, and then it dipped down into the 20s just because of the law of large numbers. Microsoft was growing maybe 20, 30, mid-30s, sometimes putting up a 40 every once in a while. Alphabet was way lower, and then look at what's happening now. These are re-accelerating. So this is not like, hey, this engine just found a second life. They've ripped out the V8 and stuck in a jet engine and re-accelerated these things. And here's what I think people are still going to complain about. But they're just spending money. It's not making them money. That's not true. Alphabet actually showing that they're generating a lot more revenue from cloud services. They actually have a backlog for all the data centers once they come online. That's more than doubled. We'll get to that in a moment. But here's what I want to tell you. The investment insights here, yes, there's obvious ways to play this boom. I mean, you can't argue with this. This is the tailwind, not just for the hyperscalers, but as Stephanie Link puts in here, for the semiconductor players, for the power companies, which we've talked a lot about here, the IRENs, the CoreWeaves, the Core Scientifics, you name it. All those companies benefit, all the pick and shovel plays that are on the other side of the spending. And I think that's the key takeaway. Let the bears harp on these enormous capex budgets. The spend is not the risk. The spend is the signal that the demand is showing up for all the parts and component suppliers that are going to be on the receiving end of that spend. So don't look at the spend line, the expense line on the hyperscalers. Look at the revenue line on some of the companies that are receiving that. And, you know, we'll get to that. We brought up plenty of pick and shovel plays along the way. The boom is real. And how do we love to play it? I'm telling you, let's double down on things that are already working. So this week's money chart shows you, beam me up, Scotty. Look at what's going on at Alphabet. Now, mind you, this was a company that was just openly scorned. Always be closing, if you ever saw Glenn Ross, but I can't remember why I said ABCs here. It's always be computing. That's whatever. I forgot the great analogy I had, but here's the key takeaway. Alphabet this time last year was trading for about $150 per share. People were writing them off, that AI was going to eat their entire online search business. And then lo and behold, the bubble babblers and the fear mongers were completely wrong, and all the headlines were. And we were banging the table to buy Alphabet. It's more than doubled since that time, but here's why you should keep buying it. It's not extremely cheap like it was. It doesn't have a lot of regulatory risk like it did then. What it does have is booming growth, and you can see it here in this chart. Last quarter, the backlog for Google Cloud was only $240 billion. I say only jokingly, as if $1 billion wasn't enough, but it went from 240 to 460, almost doubling. This is not fictitious business. This is business in the backlog that's going to come online. So, folks, the money chart this week is right here. Beam me up, Scotty, which is going to beam up Alphabet's share price over the longer term. And that's the investment insight for this week. If you haven't added Alphabet to your portfolio yet, what in the world are you waiting for? It's at the epicenter of the AI boom. So keep buying Alphabet, especially since they've got a lot of gains coming from the SpaceX IPO, early investors in SpaceX. So this is a company that is kicking on all cylinders, generating profits left and right, and really growing in the center of the AI boom. So don't forget it. Keep buying Alphabet. Maybe you disagree. I don't know. Maybe someone's listening that actually followed our advice last year around April and May to buy Alphabet. We'd love to hear from you. We'd love a congratulations right alongside us, because the stocks performed really well. But we're not here to take a victory lap yet. I think there's much more room to run. It was on sale last year. Yes, it was. Absolutely. So is it a screaming bargain and buy like last year? No. But is it still a good buy? Yes. I will tell you this. Most investors make the mistake of doubling down on their losing picks and trimming from their winning picks to fund that, when we actually should be investing more in our winning picks. As always, Alexander here from Los Angeles, just saying hi. I appreciate you, Alexander, always showing up on time and letting us know you're here. So thanks again for joining us. And all of you else out there, please join the conversation. If you've got a better stock pick right now, we want to know. We'll dive in real time and break it apart. Take a look at what could be the drivers, the catalysts, why it could be a good investment, a great investment, or a shitty investment. So we're here at your disposal for the next, 47 minutes or so. But we've got much more room to cover here. We've got a top tier guest list this week, including the Dodd man that I'd love to get to. But before we do, make sure you never miss an episode of The Big Skinny by subscribing to our YouTube channel. We're trying to be a smidgen like Mr. Beast. So we just want a fraction of his following. So subscribe there. You'll get reminders all the time. You'll also get reminders of other interviews that we do. We're not just live. We're actually recording episodes throughout the week that we're started to release. We're going to talk to you about those. But don't forget to follow us on Twitter as well. Elon Musk will one day follow us, and we'll start calling it X. I believe this day will happen. But more than important than that, go to thebigskinny.com and sign up for our newsletter, where we serve up the insights, not just on Thursdays at 5 p.m., one headline, one chart, one insight at a time, but 2 to 3 times throughout the week. So if you're looking for great ideas from great investors, I'm not talking about myself, but other investors that we interview, make sure you're signed up for the Big Skinny at thebigskinny.com. And we'll be right back with our first guest right after this message.
That is 38. That will pay 1 week of interest on the national debt. It pays 1/4 of a month.
Slow and steady.
I got to give credit. A friend of the show, Tom Hayes at Great Hill Capital Management. Turnaround Tom called this. He was early. I doubted him. I've now learned to not bet against two people, Elon Musk or Tom Hayes.
So let me just walk us through the results.
Yeah.
He likes Papa John's.
Significantly surpassed analyst expectations. This rally was a blockbuster earnings beat and a robust outlook for the quarter, signaling a faster than expected turnaround. Basically, Intel's CPUs are back. They talked about revenue up 22% year over year to $5 billion, driven by high demand for some of their Xeon 6 processors and Gaudi 3 accelerators. All of that sounds like gibberish to me, but all you need to know.
Gaudi 3 accelerators? Wow. The flux capacitor is back, baby.
We should sell.
Well, welcome back to the Big Skinny with me, Lou Basenese, and this is the beauty of a live show. Sometimes you got to adjust on the fly, and we don't know if something happened in the interwebs, but Mr. Elliott's not here yet, so we're zooming right along to Mr. Zaccardi. So Mike Zaccardi, the founder and financial writer at Zaccardi LLC, welcome to the Big Skinny all the way from Ponte Vedra, Florida, my friend.
Hey, thanks, Lou. Great to be here.
No, I appreciate you joining. And look, I tell people, admittedly, I'm always the guy that's like smiling and optimistic about the world. And I feel like from reading your content so much, you just take a very pragmatic view on the markets, and really wanted to talk to you about some of those views because I think you have a unique perspective because you consume so much great research and you're curating it and deciding what to put out there. And one of the things that struck me that you wrote about and posted about recently was just the fact how high oil prices really haven't slowed down this economy. What do you make of that? What's kind of your take when you see that? The stock market and the economy for that matter.
Yeah, I mean, I think the big thing is you see $100, $110, $120 barrel oil, and it's a shocking number just because late last year we were 60s flirting with 50s on US oil. But you take a step back, you realize that June, July 2008, we had oil much higher. We had gasoline prices sort of where they are here. But of course, back then, people were driving much less fuel efficient cars. They had less money. They were less wealthy. So there was that period. And then also the period from 2011 to 2014, we had sustained gas prices kind of at near this level, near $4 a gallon back then. Of course, adjusted for inflation, they would have been much higher. And then the brief time in 2022. So it's like we've seen the economy has handled this before. So while the upward move has been dramatic, and it makes for really scary media headlines, ultimately it's just not a huge deal for the economy right now. I mean, that would change if gas prices got up to $6, $7, $8 a gallon. But
yeah, it's funny.
As it stands now,
you brought up the scary media headlines. I clipped one here. It was from Market Watch talking about if $200 oil and how that would just basically tip the world into a recession. I mean, what have you seen? Have you seen many predictions for $200 a barrel? I mean, I'm looking at it like 2022. We saw the futures curve stay above 100, 6 to 9 months out, and we're not seeing that right now. So do you think that's a real threat based upon some of the research and smart insights you've been consuming?
No, not really. I mean, kind of the game the sell side plays with this is they can take a look at the futures curve and they might say there's a like 10% more upside risk to that. So, and then we saw that kind of this week. We have December oil trading around $80 a barrel, and then you see the sell side come out and say, "Oh yeah, it could go to 90." I mean, that's the game they play. It's always 10% higher. That's what they do, and they put a nice story around that. But certainly nothing around $200 a barrel that far out. You do get to some interesting quirks with how the energy markets work on the futures curve. When you see that really steep backwardation with those front month prices pushed up so much, I mean, it really is indicative of a bullish market. And kind of the likely scenario is you're going to see those later dated contracts, a few months out, start to roll up, move up in price if nothing else changes. So, if the status quo stays the same, while this fall we could be looking at $90 in the curve, that is probably going to drift up to 100 unless something else changes. But even still, I mean,
Yeah, so it's
where
all
we are
about the
now.
duration. The longer this lasts, the more of a drag it becomes. But I mean, I think you shared a chart too, showing the S&P 500 in COVID era, right? As oil prices were soaring. You don't think this is exactly the setup that we're seeing right now, right? I just want to make sure I understand. We can bring up that chart here too. That oil screaming higher, getting early 2020 vibes. COVID risk ignored then, and we got the 150, and then they'll just tank in the market. But you're not seeing that, do you?
No, see, the way I look at it is like this is like 95% of the time, the stock market is like your best indicator of what's going to happen in the economy. But there's always those one-off instances where it just gets blindsided with something where it may, like with COVID, it kind of prices in the fact that, okay, this is probably not going to be a huge deal.
Right.
But then it gets it wrong. And when it gets it wrong, it's something really extreme in terms of price action. And so there's always this like kind of lingering thread. And this, you could translate this to the energy shock now is if we do see $150 to $200 a barrel oil or higher, I mean, that could be the kind of event that's comparable to COVID price action.
Yeah.
So that's always a possibility. I mean, you can't dismiss that. But yeah, for now, it is kind of remarkably similar how back in 1920, we were just kind of riding that escalator up and just got slammed with that market topping out in February of 20.
Yeah, I remember it all too well, and not for a good reason. I went through a divorce in February of 2020. It was finalized, and I watched my net worth diminish and then diminish again thanks to the market. So good times, my
Ouch.
friend, way better. But you got this other chart too, which I think is really interesting, talking about what oil is having an impact on European stocks, which this time last year, that was the trade of the year, right? Like get long European stocks. They were so undervalued. What do you make of that? I mean, obviously it's a bifurcated market where Europe is struggling much more with the higher oil prices and jet fuel prices. How do you see this playing out? I mean, is it a real long-term risk to the European rally, or is it really, again, something that should be transitory as long as, and I dare I say that Powell word transitory, but as long as this conflict in the Strait of Hormuz opens up in a reasonable amount of time?
Yeah, so Europe has been underperforming now since February. Hasn't been a very long duration, but of course, they are more exposed to Middle East oil. So as Brent climbs and we see natural gas prices over there start to creep up, it's natural to see the stock 600 underperform. It had a great day today with the dollar dropping. That had a little bit to do with what was going on with the yen currency pair. But they're still below their February highs even after today's rally. So that's something I'd be looking out for. If we see European stocks break out to new highs, that would certainly be another sign that the energy crisis is maybe short-lived.
Yeah.
But for now, U.S. versus ex-U.S. is right near multi-month highs. It's one of those situations where it's not like we're seeing all that much weakness in overseas stocks and European stocks. They're just not performing quite as well. So, it's certainly not a red flag, but just something that we should be mindful of from a global breadth perspective.
No, I think that's a great point. If we start seeing European stocks take off again, that's a signal that the market's figuring out this is ending when people haven't figured it out yet. You brought it up at the top of the interview here, and I think it's a key point. We talk about gas prices and how that impacts. I mean, even though we have much more fuel efficient cars, we're energy independent this crisis now. You get $6, $7, $8 a barrel gas. I believe today we ticked over $6 in California. $3 of that's probably taxes, but it doesn't matter. It still hits, consumers the same way. Where do you think really that pressure point is? And is it about duration, right? It's not about just touching 7 or 650. It's about how long it stays there. When do you start to get worried when you look at the charts here?
I mean, I think it's got to go way higher. I mean, you look at some of the latest spending data, like B of A put out their weekly spending summary today, and they just show no signs of letting up. Even when you look at consumer spending ex gas, is still super strong. So even if like this Kalshi number comes to fruition, 520, now it's up to like 550 in terms of the absolute max AAA average price for the year.
Yeah.
I think we got to go higher than that. It'll be one of those things where people will act like they're super pissed off about the whole world, but they're still traveling. They're still sending their kids to, wherever to spend as much money as they want. I mean, and of course we're talking about, the K-shaped economy thing is real, where we have the upper 20% who just does not care about this. And as long as that's not disrupted, we're going to keep seeing strong consumer spending. I mean, maybe the jet fuel prices seep into airfares more so as the year goes on. That could kind of weigh on things. But even Visa, MasterCard, I mean, Visa had super strong cross-border transaction numbers from Q1 as oil prices started to creep up. So,
Yeah,
I think it's got to go way higher.
Yeah, no, I agree with you because you mentioned today's new updated data from B of A, but I was looking at last month's and there was no impact, right? Like consumer sentiment hits an all-time low, yet spending is chugging along as if nothing's wrong, right? So it's, to your point, I don't want to belittle the fact that yes, there's a K-shaped economy, that this higher gas prices impacts the lower part of the economy much more, but there's still people traveling everywhere. I mean, Royal Caribbean reported earnings and they had like last minute bookings were up. So like even all parts of the economy are still seem to be spending very strongly no matter what.
Yeah.
So let me ask you this before I want to make sure people know where to find you. Where's the bet? I think it's on X, but you have a subscription where you provide unique charts as well that I'm benefiting from. What's something that's kind of new that's bubbling up? I mean, again, I think you have a unique perspective because you consume so much. You're looking at and you can see where the consensus is and what deviates from that. So what's one of those things that's bubbling up in the last week or two that you think is something to keep following that could be a trend that becomes worth a signal for investors?
Yeah, I say take a look at next week's jobs data because we've seen a nice pickup in the weekly ADP payrolls numbers. So if we see that backed up by Revelio number we'll get before the Friday payrolls report next week, challenger job cuts, and we had that claims number today that was the lowest since 1969. So I think we may be transitioning from the no hire, no fire environment to no fire, some hire, and
Right.
we'll see where that goes from there. So on net, I think that's fine because we've seen rate cuts get priced out of the market in the last few weeks, and what's happened, stocks have gone up. So I think it's a situation where good news on that front is still good news.
Yeah.
So you can really draw parallels between what's going on in the rates markets with energy. It's like, people talk about how the Fed being on hold and not cutting may be a bad thing, but we're not seeing that at all in the stock market. We've seen rate cuts come out of the market, stocks go up. So to me, if we get a solid number next week on across a set of jobs numbers, to me that's a good thing at this point.
Yeah, I mean, because that would be the second month in a row, right? Because we started the year in a weird place where January looked strong, February was the disaster, then March came in strong, right? So like if we get another strong print for April, I think you're right. That could be the signal. What do you make of, I mean, what have you seen in terms of research, in terms of AI impacting hiring, firing? Because we covered a few weeks ago, just this fact that like AI has become a great scapegoat to say like, hey, we're having layoffs, but even though it was just really tech companies that overhired. But I'm just curious if you've seen similar trends or some other trends that are relevant to AI in the job market.
Yeah, I think there's structural things at hand with that. Like you said, the overhiring from 2021, 2022. And we've seen a pretty solid demand for software jobs right now, and you wouldn't think that'd be the case if we're seeing AI penetrate the corporate world to that extent. So yeah, to me, it's a bit of a canard. I think that it's having an impact, but yeah, I don't think there's not enough data to suggest that it's causing layoffs across industries at this point. If that were the case, I think we would have seen that already.
Yeah.
So something new has to happen for that to take place.
No, I agreed. Agree. Listen, man, I appreciate you joining, being willing to go out on a limb and take a chance with us here, man. I love your content. I encourage everyone listening in, whether you're listening live, listening to the podcast, or listening to the replay, to check out Mike Siccardi on X. Sign up for his subscription. It's way better than the free stuff. I'll say that and give you a glowing endorsement because it's the truth. No one will be disappointed. Would love to have you back in the future if you're up for it, my friend.
Yeah, sure thing, Lou. Sounds good.
Awesome. Well, enjoy this sunny and warm weather there. We're getting a little bit of a cold spell here in New York unexpectedly in May, so I don't get it.
Oh, will do. No problem there.
All right, my friend. Thank you again for joining the Big Skinny. Listen, these are the types of conversations that I love. If Mike ever travels to New York, I'd love to pick his brain for 20 to 30 minutes, just like I had the opportunity to do with my good friend and fellow Fox regular, Tom Hayes of Great Hill Capital Management. For those of you that don't know, that didn't listen to the episode, that aren't subscribed to our YouTube channel and didn't get the alert, go there right now. Go save that. Go download it into YouTube so that you can watch it later. And here's why. It's not because I'm awesome. It's because Tom is. Tom has one of the best hedge fund track records that I've seen in recent history. His cumulative return after fees for the last 3 years is right at 130%, just under 130%. He had a 60% year, a 46% year, and can't remember what the other one was, but he's one of the best hedge fund managers out there. He only invests in maybe 6 to 10 companies at a time. So high conviction, deep value, turnaround Tom is his nickname. And we're going to show a clip because he even convinced me, a self-respecting Italian that loves New York, New Jersey pizza, that grew up on it, that I might need to try Papa John's. They have a deep dish pepperoni that's going for a Michelin star, if you can believe it, of all things. I didn't believe it, but listen to this clip that we have of him convincing me why not only is their deep dish pizza a must try, that their stock is a must buy as well. Did that sentence just come out? Like, is that true?
They're legitimately trying to get it submitted for a Michelin star. I know good pizza. I would say, look, Papa John's is pretty darn good by California standards. The big thing here is, so they've had a problem. They kicked out the founder. That's always a mistake because they're the lifeblood. So they've gone through all these CEOs. Now they've got Todd Penegor. He came from Wendy's. He turned around Wendy's for Nelson Peltz.
Yeah.
And he took Wendy's from the number 3 burger chain to the number 2. They took out Burger King under his tenure. He had a 3-bagger in the stock. If you could turn around Wendy's, you can probably turn around anything. So what did he do? He brought in the guy from Domino's. And for anyone who follows the stock market, Domino's has been one of the biggest growth stocks for the last 15 years, highest overall returns. But the point is, the guy who ran digital for Domino's, the reward system, the order tracking, the app, he poached him and he brought him to Papa John's. And they're implementing it. I got to tell you, this could be a double plus over a 3-year time period.
I got to tell you, never in my career would I sit here rethinking like, man, Domino's kicked ass and is a great investment. It's still kicking butt. Papa John's, right? I mean, I've learned not to bet against Elon Musk and not to bet against Tom Hayes. Tom Hayes went long in Disney when they were embroiled in a battle in the governor with the governor of Florida. He bought Intel when no one wanted it until President Trump said, hey, the government needs to buy a stake in this. So Tom has time and again shown that buying these stocks that are down 70, 80% that meet his criteria for potential turnarounds that he has honed his craft over decades in doing and is independently wealthy because of it, work out really well. So Tom in this episode didn't just provide a recommendation of Papa John's, even though that's all we ask of our guests is one headline, one chart, and one investment insight. I encourage you to check it out. The QR code is on your screen, or go to our YouTube channel if you're listening. It's an interview with Tom Hayes where he gets into Papa John's. He also talks about an automobile parts company that you've probably never heard of, Cooper Standard, that makes a necessary but totally unsexy component on every car, truck, van, minivan, whatever. It's that just the rubber casing that goes around the doors that creates the seal. And he's lays out the case for that, why that is a definitive rebound company. It was trading at $5 when they were starting to buy it. It's now at 30. He still thinks it could 4 or 5x from here. And then he also gets into, if you live in California, you know this all too well, Vans, shoes. Again, these are not investments I ever think of. I love new, innovative tech, sexy drugs, med devices, not real drugs, pharmaceutical drugs. But Vans, like, and the perfect corollary for me is look at what happened with Birkenstock's stock price. Look at what happened with Crocs stock price multiple times. They came back in style and those businesses boom. So I encourage you, if you haven't listened to the episode yet, and if you haven't checked out Tom's content, find him at hedgefundtips.com. Listen to our interview. We have a lot of fun. We get through some other really good insights as well. So with that being said, don't forget to follow us on X, where I put out insights on the regular, not as regular as Mike Zaccardi, but we try and have some interactivity there on a regular basis in terms of what's going on in the markets, particularly on days like the last two, where we've had so many corporate earnings reports moving stocks that we follow and that are considering. So follow us on X. We'll be right back after this break, hopefully with Bob Elliott, from unlimited funds, if he didn't make it, we still got plenty to talk about. So no worries, no rush. We'll be right back after the short break.
A live look at the Federal Reserve now, where the Fed will make its decision on interest rates. It is that day, top of the hour. We're going to get that news. Meanwhile, Kevin Warsh moving a step closer to the Fed chair post. After clearing the Senate Banking Committee, his nomination now goes to the full Senate for a vote. So let's bring in our Fox Business contributor, Lou Basenese, and Solus Alternative Asset Management strategist, Dan Greenhouse. Thanks to both of you. A little bit limited on time here with a lot of breaking news, but give us your expectations for the top of the hour.
The good news is there's no news coming from this. There's not going to be a cut. Everyone knows there's not going to be a cut, and we're just waiting for the political theater to end with Powell and to transition to Warsh. I think the surprise is going to be people are expecting Warsh to be very dovish, and I just don't think, if you look at his policy and his history, he's more naturally a hawk than he is a dove. So I don't think he's going to fall in line with the president.
The important
All right, welcome back to the Big Skinny. Surprise, surprise, we got Bob on the line. I am thankful that he was able to make it. So without further ado, Bob Elliott, CIO of Unlimited Funds, welcome to the Big Skinny for the first time.
Thanks so much for having me.
Good to have you. We don't have your audio yet, so I'll brag a little bit about you, your background at Bridgewater. We actually have a friend in common. I went to high school with Chris McIntyre. You guys are fellow Bridgewater alums. I want to talk to Bob once we get his audio figured out about some of the things that he's been posting, because I think he's got great macro perspective. One of the charts he put up recently was talking about expectations for GDP growth in 2026, getting a little ahead of themselves, and inflation just not as high as we thought. And it's creating what CNBC is dubbing a boom session or a vibe session. So in a moment here, we'll get into just the ins and outs of that. What does that really mean if the GDP forecasts are off base? If we grow not at 3% or 4%, but at 1%, how does that impact the stock market, earnings growth for corporations that are reporting double-digit earnings? You would assume that if the economy downshifts, that those earnings growth, the mother's milk of stock prices, right? Earnings ultimately drive share prices. If that changes, then we're going to have to change our investment outlook and approach. By the same token, if inflation changes, right? If inflation reaccelerates like everyone has been fearful of, the Fed actually might be having to face the scenario of raising rates. Are we good? We got him.
What's going on?
All right, my friend. Listen,
I don't know what happened, but technology gremlins are there. I'm here. Let's do it.
Let's do it. I appreciate your perseverance. As Chris and I, our fellow friend, went to Del Barton, we had this saying, the motto there was Suchisha Varesha, cut down, grow back stronger. Tech's cut off, we come back stronger. So we got less time. We're going to kick the insights in. But what do you make of this? CNBC is talking about a boom session. A boom session. We got stock market ripping, but the economy not necessarily following suit. You tweeted out recently a chart that I thought is really interesting, that the GDP growth expectations for this year still a little hotter than they really probably should be. What do you think? What do you make of that? What's the significance?
Well, I think one of the challenges is we continue to have this sort of flow of capital towards various manias. And, early in the year, it was gold, and then it was silver. And now we're seeing a mania in AI related names. And, it's part of what has become a real gamified set of equity markets and asset markets in general. And so, look, semiconductors are up 50% in, 4 weeks. Like, our view on the AI dynamic has not changed 50% in that period of time. And so I think it's mostly an indication of mania. And the trouble with these manias is there's always the narrative that comes in behind them. But in the end, they always end up petering out, and, the speculation moves to the next interesting thing along the way. So I think we're near the top of that on a tactical sense.
All right. So I love this because I'm guilty as charged. I'm part of the mania in terms of AI. If you caught the beginning of the show, I was talking about how these, everyone points to the capex that's going through the roof as the risk. And I just point at it from the other side, is that's the demand signal for the people on the receiving end, right? Like, it's an expense item for Alphabet, Amazon, Meta, et cetera. But the chip makers that are supplying that, right? Like the data center provider, all those things, those guys are actually making more money. But you said it interesting, tactical. So where do you think there's the next tactical opportunity? Because if I look back last year, there was a great tactical opportunity in energy that's worked out. Semis have had this mania blow off top, what is what you're maybe predicting. Where do you think there's another setup? Like we had a guest talking about housing, financials, maybe healthcare because they're undervalued. Do any of those excite you as potential next tactical allocations?
Well, I think the risk is that that the strength, the continued challenges with oil, and the tighter monetary policy that's likely to come with it than people had expected creates the risk essentially of popping the mania, at least in the short term, more broadly. That's the real risk here. And so, any small group of stocks can go up in here or there, but ultimately, what it comes down to is you have to have real economy strength to support essentially the narrative and then ultimately the pricing that happens. And we're not really seeing that. And even before the oil shock was starting to flow through, we were already seeing weakening of household demand, et cetera, into the beginning of the year.
So you're not buying the narrative that the back half of the year is going to be backloaded with economic growth from tax refunds, from capital expenditures, getting more favorable tax treatment. You're not saying that that's a guaranteed thing. You're saying it's a much more tenuous relationship. And how do you trade that? What's the trade for people? What's the tactical, play to protect against those things not coming to fruition?
Well, I think a lot of the benefit from one big beautiful bill, A, has already been priced in the market and was priced into the market long ago, and B, has already had its support to the economy. And the challenge is all of those great tax refunds gone with higher oil prices, plain and simple. But the higher oil prices remain, and the tax refunds are gone. That's the problem in the economy right now. Now, of course, if we swiftly resolve the situation in the Middle East and oil plunges and we open up the Strait of Hormuz, then probably things will be fine. But in the status quo, we are very far away from resolving that. And certainly, if anything, the back half of the year risks more pain, not less.
Yeah, probably things will be fine is never an investment strategy that people like to follow. So talk to me about unlimited funds, what you do there. We're going to pull up a QR code on the screen so people can visit the website, learn more about your products, but really tell us what you're accomplishing there. What's been the best performing fund and what do you think, just kind of your outlook?
Yeah, so I spent a long time in the hedge fund business, and after many years in the 2 and 20 side of things, now I'm bringing hedge fund returns to every investor. We've got a variety of different hedge fund strategies and ETF products that are available for everyone. Probably the most interesting is our global macro strategy, HFGM, up 50% in a year. This is a macro environment, and tactically trading macro assets like oil and gold and stocks and bonds is incredibly lucrative in this sort of environment. And so definitely check that out, see if it's appropriate for your portfolio. That's HFGM, like hedge fund global macro.
I love that because here's what I always said about global macro. I'm a top down, bottom up guy. I've never done well just being a macro guy because I would say you could get 99 out of 100 variables right, and that one you got wrong screws up your entire investment. So that's why I would never have. You didn't hear the intro, but I said you at least have a 90-point higher IQ than me because of all the success you've had. But I love this taking what was used for institutions to Main Street. Talk to me about the construction of the fund. What are the underlying investments that you're using here as you're rotating between macro themes and opportunities?
Yeah, the neat thing that we're doing is we've actually created some technology that allows us to look over the shoulder of all the major macro hedge funds in the market, 500 different macro hedge funds, and basically take the wisdom of the crowd and package those views into an ETF that's tactically moving around every day. And so we trade global currency, commodity, fixed income strategies all together in just a single ETF wrapper.
I love it. And what's the expense ratio and how much assets under management so far?
The expense ratio is 95 basis points, which certainly compares favorably to 2 and 20.
Yes.
And we've got about 130 million bucks in it, just raised check by check. So it's growing like a weed, and it's number one in its Morningstar category since inception and since this beginning of this year.
So when did you launch this fund, the CTF?
A little over a year ago.
Man, that's phenomenal, right? Great track record, guiding to 100 million AUM over for people that are listening that don't know. That's a very big milestone, which means Bob Elliott, you're going to be at the helm of $1 billion ETF before too long, because you hit the 100, the next 900 comes a lot quicker. So
I sure hope so.
yeah. Well, I wish you the best of luck, man. Anything else you did tweet out earlier today I thought was interesting, just kind of the liquidity that's going to come out of the markets and get sucked into these IPOs. What do you make of that? Because I think it's the most interesting year set up for IPOs. We have these multi-trillion-dollar IPOs that are going to come and probably fall flat on their face, because that's what the performance has always been. What do you think the bigger impact is into the markets if those?
Yeah, I mean, if anything, the performance has gotten a lot worse over the course of the last 10 years, give or take. I mean, the market has been surprisingly supported. You don't really think about it this way, by essentially a no IPO environment in much of the post-COVID period.
Yeah.
And so now we're opening up the taps. That's just simply supply that's coming into the market. And it's coming at the same time that we're seeing some of these big AI names basically cancel their buyback approaches. And so historically, if you look over the post GFC, let's say, corporate buying has been actually more important than pretty much any other source of demand, shrinking the amount of shares that are available, squeezing the market. And now essentially that's going to flip on its head. They're going to be a source of supply ahead. And that's from a supply demand perspective, is really setting up some risks in the second half of the year.
Yeah, no, I agree. And we saw it today. Actually, I don't know if you went through the Apple print, but they announced an additional $100 billion buyback, while the rest of the Mag 7, their counterparts, were basically spending an extra $100 billion on scaling data centers and stuff. So
yeah, Apple is sort of a deviant amongst the Mag 7, not betting the farm on their AI capex. So that $100 billion basically keeps their buybacks consistent with what they've been.
Yep.
So the real change in what's going on is what we see with the rest of the Mag 7 pulling back.
Any other risks that are out there? Because I like to talk to guys like yourself who get a very good feel of nuance and subtle changes before they turn into major things. But what's the biggest risk that you worry about in 2026 and early 27?
Well, I think we've really been benefited from just an easing of monetary policy that's affected that's supported everyone. And it's one of these things that in no one day does it feel so good, but you look back and you're like, oh, stocks are up 40% because we've cut interest rates a ton and the Fed's expanded its balance sheet, and the treasury is cutting its duration issuance. A lot of those things are going to change in the future. The Fed is no longer going to be cutting aggressively. Certainly not in a 4% inflation environment.
Right.
The Fed is probably going to curtail its balance sheet expansion ambitions, certainly given the rhetoric that we've seen. And so you see a sort of circumstance where all that juicing that's happened the last couple of years, the dividend from disinflation has already happened, and now we're entering a period of central banks hiking, and that is just a very different environment. It's we almost forget 2022 when central banks hiked. I'm not saying it's going to be that bad, but that sort of dynamic can certainly happen in the markets in the second half of the year.
Yeah, no, look, I think it's a fair warning. I think it's absolutely the risk that gets forgotten right now because times are good, right? And it's easy to not think about what could go wrong. Listen, man, I would love, I know we're both here in New York, so when you get time, I'd love to get you in the chair next to me, have a longer conversation about the things that you see and what you're doing and how you're adjusting, because your track record is a testament to you being spot on. So congratulations on that early success and to much more to come.
Thank you so much for having me. It was great to catch up.
Yeah, appreciate it. And say hello to Chris if you see him before I do next.
I will.
All right, my friends. Thank you all for tuning in. I mean, this is the thing. We said it at the outset. Be humble in the markets or be humbled by the markets. The easiest way to be humble is to talk to people that are much more experienced, much more savvy, and or your counterparts that are just doing completely different things in a specialty in an area. I admittedly don't get into macro bets and plays. For me, historically, it's just been too hard to understand that world and consistently. I've cut my teeth going from the bottom up in individual companies, single security selection, mostly in the technology space. So really appreciate Bob Elliott. Check out his unlimited funds, that hedge fund global macro. Obviously, the track record speaks for itself, but also check him out on Twitter. I think he's got 300,000 followers, and he puts out great macro content as well. So again, trying to be a value add for you here, not just with our insights, but with the insights of really smart people. Don't forget to follow us on all the socials, and we'll come right back after one more short break looking forward to some interaction with my partner in crime here, Dodd, but with you as well. Don't forget to join the conversation. We're live streaming on X and YouTube all the time. We'll be right back after this short break.
Wait for it. Lou and Brian, I do this for you. An analyst reported that industry checks indicate that OpenAI is collaborating with Qualcomm to develop specialized smartphone processors, maybe trying to take on AI. The partnership is aimed at developing hardware to advance on-device AI capabilities.
Can you translate that? Does that mean
all roads lead to Apple? Because right now we're dealing with AI systems that are on separate devices. But guess what Apple owns? I don't even have it. You have an Apple device. It's like a 13, isn't it? That's where AI compute is going to get done, and that's how Apple's going to own AI.
This is not going to do any AI.
They don't have to worry about. You get specialized silicon that comes out and specialized chips that Apple owns, and it can do the compute on the edge. It becomes a privacy issue because then now OpenAI doesn't know what I'm doing because it's on my device. All the calculations are happening there. So I think this is the big thing that everyone is underestimating with Apple.
And Apple's been a lot stronger.
All right, folks, we're plugging and chugging away on this episode of The Big Skinny, where we don't let sound, tech issues, anything, late guests because they had issues, anything get in our way. So don't change it, Dodd.
Ran the gamut today, Lou. It's all good, though.
Hey, it's one of those things when you're just running, you get a body in motion and you just keep going, right? You just take the hits as they come and adjust. No, look, I'm always struck by, before we get to one of my favorite segments and headlines and head scratchers, because we have fun with it. I'm always struck by the smarts of other people, right? Like Tom Hayes, just individual stocks, turnaround. Like there's so many different ways to make money that I think it probably overwhelms the everyday investor that's new to this game, right? And that's why we're trying to level set and say, hey, here's the simple things you do. Here's the smart people to follow, because there's just so many of them, and you can get overwhelmed if you try and follow all of them.
Yeah, didn't think we'd be talking about Papa John's or any sort of, pizza, and especially with you, the must be an Italian, full Italian pizza from New York.
Gotta be.
Michelin star, Papa John's, really? I'm not sure about that.
Yeah, look, I'm intrigued now. Deep dish pepperoni pizza, eligible for a Michelin star out of Papa John's. But
yeah,
all right, Chad, my friend, you should have an entry song. Like we got to get you. You are a baseball. Yes. Here comes the king of the big skinny audience, Chad Towers. All right, now what are we saying? Michael Burry. Yes, I couldn't think of his name. Both long PayPal. Michael Burry's from The Big Short. Michael Burry's made some really bold calls recently. Not all of them worked out, but when you make a massive $1 billion plus bold call, you can say anything you want and come up with these calls. But no, PayPal, odds of that, I'm not sure. Kudos to Google 164 last year. You were here for it. I love it. Thank you for chiming in. But look, PayPal, I don't like to bet against Tom Hayes, and I certainly don't like to bet against Michael Burry, because both of our last names start with B, but he has a B behind his net worth, and I do not. So
you don't? Not yet?
No.
Keep telling you, trying to get you to Vegas so we can fix this. But
something tells me New Money 0628 might know you and your affinity for F1, because we're going to be at the Miami F1 here starting tomorrow.
Knows me. Look, they just know my jersey. This wonderful McLaren jersey.
Don't rub your chest on air. You could get us in trouble. That's probably a violation of some FTC laws.
I didn't expect the camera to go in that close.
Everyone's on their A game today, and we're getting back to our game and headlines and head scratchers, where we review big calls, bold calls, dumb calls, headlines that just make us go, huh? Where are we starting this week, my friend?
Starting with Google it. The report just came out, and AI, Google is killing it. And I guess showing real profits a lot sooner than everybody expected, or
I think. Well, no, they just showed they're going to be a player. This time last year, no one thought they'd be a player in the AI race. But Geiger Capital here is a bit of a parody account that everyone should follow as well. But he put it bluntly, like, put your entire portfolio in Google last April, and you could have sat on the beach and you've been up almost over 150%. You stupid idiot, right? So, this is always what I find out. I don't remember it, like you and an investor too, and people listening. When you get a big winner, you're like, damn, I should have invested more. I should have put everything into it. And actually, no, you shouldn't, because that's when they go the opposite direction. And then you absolutely undermine what you're trying to do. So position sizing is key. Adam Johnson was a guest of ours a couple weeks ago, and he talked about in his American Ingenuity Fund, everything starts off at like a 4 or a 2% position of the portfolio, right? So if you have 100,000 to allocate, you're putting $2,000 or $4,000 into each name just to get started, to make sure that you make money going up, but that you don't blow yourself up if that stock doesn't go up. So Google it. It's crushed it. It's still a big buy. Now we're moving on to popcorn, right?
Oh man. This one, okay, so might not have anything to do with investing, but we need
That's why we like to have fun. We talk about things that are pop culture, and you and I randomly this week were arguing with one of our fellow colleagues about the best movies of all time, and I come across this list: 100 best movies of the 21st century. None of ours were on there.
I mean, this is ridiculous, though. This was done by I think 500 or wait, is it 500 directors, actors, and critics voting from 2000. So basically, nobody on this list, I think, goes out of their homes or anything like that. I mean, we didn't show the list because it's just too detailed, but just looking at the top 9 there: Parasite, Mulholland Drive. I mean, really? I mean,
dude,
some of these things are
Kill Bill volume
Yeah.
1, number 61 on the list. How does that outperform Good Will Hunting, Shawshank Redemption? I mean,
they weren't even on the list.
I know.
That's insane. But Brokeback Mountain was on the list, so I mean, at least you got one of those on there for you. You like that one, I know.
I'm not even going to touch that one, my friend. Mulholland Drive I'll touch because that's my mom's maiden name. So
Yeah.
Mulholland Drive made it on there. This is what's interesting to me as well, is I just totally
Wally at 34. Wally.
Yes.
Wally was on there, but Shawshank Redemption, which is I think my all-time favorite movie, and I know you like Good Will Hunting, which I also love. That neither one of those.
A river runs through it. Brad Pitt, Robert like The Natural. I mean, so many. No Will Ferrell movies either, if I remember correctly, which angers my wife, because that whole genre, the Will Ferrell genre, like, she thinks they're all amazing. I think they're all just like the template cookie cutter, but he didn't even make the list.
Yeah, I mean, not 80% of these I've never heard of, which is ridiculous. And Superbad was number 100, so I at least gave a little nod. That was decent.
Yeah,
I could
Superbad, almost Superbad as your joke before, but this is something else. Let's be self-reflective here. Maybe you and I just are not very cultured. Maybe the 500 actors and directors and producers are basically saying, like, you two jabronis don't know anything about good art. So we'll move along.
I mean, I'd argue that Tommy Boy should be on that list, but understand that I'm in a different, a different category of movie buff. But
yeah. So
it's ridiculous.
Moving on to other things that make me go, that I don't just understand, right, was the crypto craze. And then look at what we see here. It's waning. If you look at Robinhood's quarterly results, they break out what their transaction-based revenue, where it comes from, what buckets: stocks, options, crypto, and other. They've gotten into prediction markets. We'll cover that here in a moment. But you see, crypto went from, if I can read, I'm not blind yet.
48%. I believe.
Yeah, down. Yeah, it's like 221 million last quarter, now 134. That light gray is the crypto. So you can see, if you scan across, like, it's wild volatility in terms of where they get their revenue from, which category. And a lot of it just has to do with momentum, which is just, all right, stocks are doing well. The people on the platform are trading stocks more. Crypto starts taking off. They hot dotted over there. That's what we used to call it in the industry. You're hot dotting to the next best performer, where, last year Chinese ETFs were up the most. Let me put all my money in there. And guess what happens? Boom, Chinese ETFs tank. And then you get mad and you're like, well, now semiconductors are doing great. Let me put all my money there. And like, you just bounce from one to the next and end up churning through your account and not really making any money.
And does this, Lou, just kind of point out again such a great influx of retail investors that, AI and tech stocks just got hot and popular. So, kind of took over like you're saying,
Yeah, I mean, Bob Elliott touched on it, right? We have more disposable income, investable income than we've ever seen. And like, the wealth effect is real. It impacts the entire country. More investors are, there's more of an investing class than there's ever been. But I think there's an education that has to come. And I would tell you, we all learn by doing. And when it comes to the equity markets, you learn a lot more when you lose money. an investment. It just is, right? Like paper trade all you want, but when you put real capital behind and learn what the emotion of like, I'm down 90%. Now what do I do? Well, I should have sold when I was down 50% or 25%. So yeah, it's always a humbling experience. But I heard, this is my thing. We're going to move along to Apple. Bob said it. It's kind of deviant when it comes to how it performs in terms of like relative to operates relative to the rest of the Mag 7, because they're not going all in on all this capital expenditures. But big change here. Tim Cook is handing over the reins as CEO on September 1st. He took over. You don't ask me why I know this. I have this uncanny memory for numbers. August 11th of 2011.
Because you're an Apple fanboy. You probably have a
No,
tattoo.
I think it's because so many times I looked up all right, what has Apple stock done since Tim Cook took over and everyone said he was going to screw it all up. And I've always said Tim Cook just needs to, he doesn't have to say anything, just point at the scoreboard, right? It's like everyone else talking trash and he's just like, dude, we're killing it. But here's my question. Do you know the new incoming CEO? Have you ever heard of John Turnus before?
No. We talked about it last week. I know he's a hardware guy, and I think going to take over to really just keep the ship moving. And so.
And we showed it in one of the clips here. I argue with Brian Benberg on from the Big Money Show all the time. I always say Apple doesn't need to innovate; they just need to iterate. He laughs at me. He says it's the dumbest thing I've ever said. But the stock keeps performing. Here's the thing. I agree. Like we all know, everyone knows who Steve Jobs was. People have figured out who Tim Cook is after he's delivered. To be determined whether John Turnus becomes another name, an icon of Apple, but I don't think it matters. There's such a culture there and a momentum and a business and a foundation. It's going to be hard to screw it up. It's unscrew-upable.
And I guess this here is in May, they're going to start subscriptions in the App Store. Is that true?
Yeah, look, the App Store services is the key. That's always been, we've shown the chart before. We'll tweet it out later. Is Apple's services segment has grown so much, it's larger than most companies, including net total revenue. So revenues from services were up another 16 or 17% this quarter. They keep growing, and now they're closing in on 30 billion in revenue. It's more than Tesla, more than Netflix, more than some other really big names that we'll put out in that chart in an updated version here shortly.
All right. Next one, predicted it. Obviously, prediction markets again.
Dude, this is going to be the headline of 2026, the implosion of prediction markets, because there's insider trading. They're just outright gambling. And what this chart shows, if you don't want to dig into the details, is basically most people lose money on the prediction markets. It's very highly concentrated to a small group that actually win money on these prediction markets. It's essentially gambling, which you love. I think stupid, because you're going to have a whole generation of gambling addicts that have become, not through the traditional casino games, but now through a Wall Street type casino.
Yeah, I love gambling. I just hate to lose. So that's why it keeps me in check.
Don't gamble, dude. It's the easiest way not to lose.
Oh, it's entertaining, fun. But see, I don't do anything. I don't do any gambling like poker online, any sports gambling online. I don't do any of these things. Really, I like the entertainment of a casino. But
all right, if you say so.
It's limited gambling in that way.
Well, we've come up to the end of our time, but before we run, we always have a final thought or action to take. So let's get to it. We sat down this week again for another interview, which I think is one of the most compelling technology companies out there because of what they're doing with VR and their omnidirectional treadmill, where you actually turn esports into a sport. Check out our latest interview with Jan Gutgolik of Virtuix, doing some really interesting stuff, consumer traction. But what's most interesting to me is the defense applications. They've now gotten multiple customers from the Pentagon, from all the branches of the military in the United States. Check out the latest episode. We got some great B-roll in there of that. Two last things here. Interesting chart here from Josh Schaefer, who I share the airwaves with every once in a while on the Big Money Show and on Fox Business. All the negativity and haterade that got sent Jerome Powell's way, he's still going down in history as one of the top 3 performing Fed chairmen in terms of equity return. So Caddyshack style, at least he's got that going for him, which is,
I guess, performance matters, right? So
performance matters, results matter. Bears will say, well, it's because he just cut interest rates and blah, blah, doesn't matter. Scoreboard's the scoreboard. Powell's going out. Maybe he's not leaving right away. He should. I think that's a career mistake for him. He's going to become Trump's pinata because he's staying on. Kevin Warsh is going to be the new Fed chair. But Jerome Powell can stay on until January of 2028, I believe. I don't think he'll make it that long. But anyway, before you run, Dodd and I are going to run next in the next 12 hours to F1. Look at that. We're headed out. Dude, why are you putting my head on female bodies of your daughters, I believe, as well? Because they're the
Well, you weren't there last year with us, so and you'll be there with us starting tomorrow. So I just wanted to give you a little taste of what's to come, but very excited to introduce you to the lovely world of F1, and F1 Miami specifically is a great time. So, and I want to thank our sponsors at Red Bull for hooking us up. We'll be in the the Red Bull Energy station tomorrow, thanks to Red Bull. So
extremely thankful to Jared and Sarah for setting us up with that. I will to be determined if I become an F1 crazy like yourself.
You will by the end of the weekend, brother. You will, I promise.
Make sure you got me a toddler size 4 McLaren jersey to wear, because us Jersey boys only wear short, tight shirts because we go gym, tan, and laundry.
Dude, that's awesome. That's something I would say, but you're throwing yourself under the bus before I can get there.
Skinny right here is all about self-deprecation. It's the best defense. If you grew up in North Jersey, you know it well. It's how you make fun of yourself before everyone else does. Thank you once again for tuning in. I'm Lou Basenese. That's Dodd, and we're out of here.
Go Lando.
Go Gators.
No, go Lando.